You think bonds are boring, you're probably right. But here's what nobody tells you. They're the reason the stock market didn't collapse last month, or the month before that. Bonds are the invisible scaffolding holding up the entire financial system, and most people have no idea what they actually are. Let me fix that. Picture this. You need $5,000. Your credit card charges 22% interest, which feels like robbery because it is. Your bank laughs at you. Your friends suddenly don't answer texts. But then your neighbor says, "I'll lend you $5,000. Pay me back in 2 years with 5% interest." You shake hands. Congratulations. You just issued a bond. That's it. A bond is a loan. You borrow money. You promise to pay it back with interest. The end. Except it's not the end, because here's where it gets weird. That neighbor who lent you money, he can sell your promise to someone else. Maybe he needs cash now. Maybe he doesn't trust you anymore. So he finds some guy at a barbecue and says, "Hey, this kid owes me $5,000 plus interest. I'll sell you this debt for $4,000. The new guy thinks, "Wait, I pay $4,000 now and get $5,000 later? Deal." Your loan just became a product. It's being traded, and you didn't even know. This is exactly what happens with bonds, just with fancier names and more zeros. When the government needs money to build highways or fund wars or bail out banks, it doesn't ask nicely. It issues bonds. Treasury bonds. You give them $1,000 today. They give you a piece of paper that says, "We owe you $1,000 plus 4% interest over 10 years. You're now a creditor. The US government owes you money. Same thing with corporations. Apple wants to build a new factory, but doesn't want to sell more stock and dilute ownership. So they issue corporate bonds. You loan them money, they pay you interest, everyone's happy until they're not. But why would anyone buy a bond when stocks exist? Stocks go up. Stocks are exciting. Bonds are just sitting there collecting dust and small interest payments. Here's the thing, stocks can also go down, way down. Remember March 2020? The market dropped 34% in a month. People who were millionaires on paper watched their portfolios evaporate faster than hand sanitizer at Costco. But bonds, they stayed stable, some even went up, because bonds are the safety net. When the market panics, investors run to bonds like kids to their mom during a thunderstorm. It's called a flight to quality. Stocks are the wild party. Bonds are the couch you collapse on afterward. And that interest payment, the one that seems boring, it's guaranteed. As long as the borrower doesn't go bankrupt, you get paid. Every 6 months, like clockwork, a check arrives. It's not sexy, but it's reliable. And when you're 64 and wondering if you can retire, reliability suddenly sounds pretty damn good. Now let's talk about how bonds actually make money, because it's not just interest. There's a whole second game happening that most beginners completely miss. Imagine you bought a bond for $1,000 that pays 5% interest annually. Nice and simple. But then the economy shifts. Interest rates drop. New bonds being issued now only pay 3%. Suddenly, your 5% bond is the hottest thing on the market. People want it. They'll pay more than $1,000 to own it. Maybe $1,100, maybe more. You just made $100 without the bond maturing. That's capital appreciation. You sold the bond itself for more than you paid. And this is where bond traders live. They're not waiting 10 years for maturity. They're buying and selling based on interest rate movements, credit ratings, and economic forecasts that would make your head spin. But it works in reverse too. If rates go up and new bonds pay 7%, your 5% bond becomes trash. Nobody wants it. You try to sell and the best offer is $900. You lose $100. That's interest rate risk, and it's the silent killer of bond portfolios. So bonds aren't just boring IOUs collecting dust in your grandfather's safe. They're actively traded instruments with their own entire ecosystem. There are bond markets, bond indexes, bond funds, bond ETFs. There are traders who've never touched a stock in their lives but make millions moving bonds around like chess pieces. And the craziest part? The bond market is bigger than the stock market. Way bigger. We're talking over $130 trillion globally. Stocks get all the headlines, but bonds are running the show backstage. Which brings us to the question nobody asks until it's too late. If bonds are so safe and so huge, why does everyone obsess over stocks? And more importantly, how do you actually use bonds without falling asleep or losing money to inflation? That's where things get interesting. Because here's what Wall Street doesn't advertise. Bonds protect you from yourself. They're the financial equivalent of hiding vegetables in a smoothie. You think you're being conservative, but really you're building a foundation that lets you take smarter risks everywhere else. Most people approach investing backwards. They dump everything into stocks, ride the highs, panic during the lows, sell at the worst possible time, then swear off investing forever. Classic emotional whiplash. Bonds break that cycle. When your portfolio is part bonds, the swings get smaller. Your account doesn't drop 30% in a crash. Maybe it drops 15%. That difference, that cushion, keeps you from making stupid decisions. You don't sell in a panic because you're not panicking. You're still breathing, still rational, still in the game. This is why every financial advisor on earth preaches diversification. It's not about being boring, it's about staying sane and staying invested. The real money isn't made by timing the market perfectly, it's made by not bailing out when things get ugly. Bonds are your emotional airbag. They don't prevent the crash, but they keep you alive long enough to recover. Now let's address the elephant. Inflation. Bonds pay interest. Great, but if inflation is 4% and your bond pays 3%, you're losing money in real terms. Your purchasing power shrinks. That $1,000 you get back in 10 years buys less than it did when you started. This is the bond investor's nightmare. You played it safe, followed the rules, avoided risk, and still got screwed by rising prices. So what's the move? You adjust. There are inflation-protected bonds, specifically Treasury inflation-protected securities, or TIPS. These adjust their payouts based on inflation. When prices rise, so does your interest. It's not perfect, but it's a hedge. You're not getting rich, but you're not getting crushed either. Or you go shorter. Instead of locking money up for 20 years, you buy bonds that mature in 2 or 5. When they pay out, you reinvest at whatever the current rates are. You stay flexible. You adapt. Because the worst thing you can do in investing is set it and forget it without understanding what you actually own. Some people buy a bond fund in 2019, check it in 2023, and wonder why it's down 15%. Rates went up. Bond prices dropped. They forgot how the game works. But here's where bonds get genuinely interesting. They're not just for retirees and scaredy cats. Aggressive investors use them too. How? Rebalancing. Let's say you want 80% stocks, 20% bonds. Market rips higher. Suddenly you're 90% stocks because they grew faster. You sell some stocks, buy more bonds. You're locking in gains. Then the market crashes. Your bonds hold steady while stocks tank. Now you're 70% stocks, 30% bonds. You sell bonds, buy stocks on sale. You're buying low without even thinking about it. Bonds become your dry powder, your strategic reserve. The money sitting on the sidelines waiting to pounce when everyone else is running for the exits. And that's the secret nobody talks about. Bonds aren't the opposite of risk. They're the enabler of smarter risk. They give you the stability to be aggressive when it matters, the confidence to hold through volatility, the liquidity to act when opportunities appear. Without bonds, you're all in on red, praying the wheel doesn't hit black. With bonds, you've got chips on multiple numbers. You're still playing, but you're not gambling your future on a single spin. Then there's the tax angle. Some bonds, like municipal bonds, are tax exempt. You earn interest, but you don't pay federal taxes on it. Sometimes not state taxes either. For high earners, this is huge. A muni bond paying 3% tax-free is equivalent to a taxable bond paying 4.5% or more, depending on your bracket. Suddenly, that boring bond looks a lot more attractive. Rich people know this. They stack muni bonds in taxable accounts while loading up on stocks in retirement accounts. It's not flashy. Nobody brags about their muni bond allocation at dinner parties, but it works, quietly, efficiently, year after year. So when someone tells you bonds are dead or outdated or pointless in a world of apps and crypto, they're missing the entire point. Bonds aren't about getting rich quick. They're about not getting poor slowly. They're the financial foundation that lets everything else work, the unsung backbone of every serious portfolio. And the smartest investors, the ones who survive multiple crashes and still come out ahead, they all have one thing in common. They respect bonds. They understand what bonds do. And when chaos hits, they're the ones still standing because they built something that could actually last. But knowing bonds exist and actually using them are two different things. Most people hear the theory, nod along, then do absolutely nothing. They keep 100% in stocks, or worse, 100% in cash, earning nothing while inflation quietly eats their future. Why? Because bonds feel complicated. Where do you even buy them? What's the difference between a bond and a bond fund? Do you need a broker, a financial advisor, a secret handshake? Let's strip it down. You've got three main ways to own bonds: direct purchase, bond funds, or bond ETFs. Each has trade-offs. Buying individual bonds directly means you own the actual thing. You know exactly when it matures, exactly what you'll get back. No surprises. You can hold it to maturity and ignore every price swing in between. The downside? You need serious cash. Most bonds sell in chunks of $1,000 or more, and building a diversified bond portfolio might require $50,000 just to get started. Not exactly accessible for someone with $5,000 to invest. That's where bond funds come in. You pool your money with thousands of other investors. The fund buys hundreds or thousands of bonds. You own a slice of the whole thing. Instant diversification. You can start with $100, but here's the catch. Bond funds don't mature, ever. They keep rolling over, buying new bonds as old ones pay out. So if rates rise and bond prices fall, your fund's value drops. You don't get that guaranteed return to par that individual bonds offer. You're riding the market whether you like it or not. Bond ETFs are similar but trade like stocks. You can buy and sell them throughout the day. More flexibility, usually lower fees. But same issue, no maturity date, no guaranteed outcome. You're trading convenience for certainty. So which do you pick? Depends on what you need. If you're retired and living off the income, individual bonds make sense. Predictable, stable. You know exactly what's coming and when. If you're younger, still building wealth, and just want bonds as a stabilizer, a bond fund or ETF works fine. You're not spending the income anyway, you're reinvesting. The price swings don't matter as much because you've got time to ride them out. Then there's the allocation question. How much should you actually own? The old rule was your age in bonds. 30 years old, 30% bonds. 60 years old, 60% bonds. Simple. Probably too simple. Some people can handle more risk. Others can't sleep if their portfolio drops 10%. There's no universal answer. But here's a framework. Ask yourself how long until you need the money. 10 years or more? You can afford to be aggressive. Heavy stocks, light bonds. 5 years or less? Flip it. More bonds, fewer stocks. You don't have time to recover from a crash. And don't forget the emergency fund. That's not bonds, that's cash. Boring, liquid, accessible cash sitting in a high-yield savings account. Bonds are for medium-term goals and portfolio stability, not for when your car breaks down next Tuesday. Keep 3 to 6 months of expenses in cash, then start thinking about bonds. Now let's talk about the elephant in the room. Interest rates are still higher than they've been in years. That means bond yields are actually attractive again. You can get 4% or 5% without taking massive risk. For the first time in over a decade, bonds are doing what they're supposed to do, paying you real income, competing with stocks, acting like an actual alternative instead of dead weight. But rates won't stay here forever. The Fed will cut eventually. When they do, bond prices will rise. If you bought bonds at 5% and rates dropped to 3%, your bond just became more valuable. You're holding something that pays more than the market rate. You can sell it for a profit or just enjoy the higher income while everyone else scrambles for yield. That's the opportunity sitting in front of you right now. Rates are high, bonds are paying, and most people are still ignoring them because they're chasing the next meme stock or waiting for crypto to moon. Meanwhile, the smart money is locking in 5% risk-free and sleeping just fine. Bonds won't make you rich overnight. They won't double in a month. They're not going to give you a story to tell at parties. But they'll be there when the market implodes. When your stocks are down 30% and everyone's panicking, your bonds will be sitting quietly, paying interest, holding value, giving you options. That's the power of boring. That's why every serious portfolio has them. You don't need to become a bond expert. You don't need to memorize yield curves or duration formulas. You just need to understand the role they play: stability, income, diversification, the foundation that lets you take risks everywhere else. Because the best investors aren't the ones swinging for the fences on every pitch. They're the ones who built a base solid enough to survive whatever comes next. You don't have to love bonds. You don't even have to like them. But ignoring them completely is just gambling with a different name. The investors who make it long-term aren't the loudest or the flashiest. They're the ones who understood that surviving beats winning every single time. Bonds aren't the whole game. They're just the reason you get to keep playing it.